Welcome back to Talk Tickers. This is the show where we ignore the noise, ignore the clickbait, and try to find the actual signal buried in the earnings calls.
Great to be here. And today we've got a really interesting one.
We really do. We are dissecting a company that seems to be living in two completely different realities at the same time. We're talking about Revvity, ticker symbol RVTY.
Yeah, you are spot on about the dual realities. We're breaking down their fourth quarter 2025 earnings call, which dropped on February 2nd. And honestly, if you only read the press release, you'd think the company was, throwing a parade.
Right. But then you look at the stock chart.
And if you looked at the stock chart the next day, you'd think the building was on fire.
So let's set the scene. It's Sunday, February 8th, 2026. The dust has settled. And on paper, this was a victory lap. They beat the top line, they beat the bottom line. It looked like a classic beat and raise quarter.
Except for the raise part,
Yeah.
and that's where things got really messy. But you're right, the retrospective numbers were solid.
But the market reaction was just brutal. The stock popped, about 2.5% in the pre-market? The algorithms love the headline numbers.
They did.
But as soon as humans started reading the transcript and looking at the 2026 guidance, the whole mood shifted. It cratered to close down over 5.5%. So the mission for this deep dive is to figure out why a report card that looked like an A resulted in the stock getting an F from investors.
It really is the central mystery of this earnings season for the life sciences sector. We have to dissect the gap between what management calls prudence and what the market, interprets as weakness, because this wasn't about what happened in 2025. This was entirely about what they're saying is going to happen in 2026.
Okay, so before we get into the guidance disaster, and we will get into the weeds on that, we have to establish the baseline. The Q4 numbers were objectively good, weren't they?
They were. Yeah, they really were. Let's start with the adjusted earnings per share, or EPS. It came in at $1.70.
$1.70. And the consensus was?
The street consensus, what all of the analysts were modeling, was sitting around $1.55.
Wow. Okay. That's a huge beat. That's nearly a 10% surprise.
It is. In the world of large cap earnings, a 10% beat on the bottom line is usually cause for celebration. And it was well above their own guidance range, too.
And it wasn't just accounting magic, right? They were actually selling stuff.
Correct. Revenue hit $772.1 million. The consensus was looking for about $761. So they beat the top line and they beat the bottom line.
And what about organic growth?
Up 4% for the quarter, organically.
Okay, 4%, which in this macro environment for life sciences tools, 4% is actually pretty respectable. But here is where I want to dig in, because Revvity isn't just one business. It feels like two different companies glued together.
That is the perfect way to visualize it. You have the star performer, the MVP of the quarter, which was the Diagnostics segment.
Right, the legacy business.
Yeah.
Newborn screening, reproductive health.
Yeah.
That kind of thing.
Exactly. And that side of the house is remarkably resilient. Diagnostics was up 7% organically.
7%, that's strong.
Very. It's a sticky business. Babies are born. They need screening, regardless of what the Fed does with interest rates. It's demographic, not economic.
And then there's the other side. Life sciences, the problem child.
The laggard, yes. Life sciences came in flat. 0% organic growth.
0. That sounds terrible on the surface.
It does, but context is everything here. You have to remember, this segment, which sells to pharma and academia, has been in a recession for nearly 3 years. We've seen quarter after quarter of declines.
So management is looking at flat and saying...
They're popping champagne. They're saying, look, we stopped the bleeding.
So flat is the new up.
In early 2026 for this sector, absolutely. Flat is a massive improvement. It suggests stabilization.
Okay, what about profitability? Margins.
Adjusted operating margin hit 29.7%. Now, that's down about 60 basis points year over year, to be fair.
But still, nearly 30%. Yeah, that's pretty healthy.
It's best-in-class territory. It shows they have pricing power and they're managing costs well.
Okay, so let's recap the good news. Beat on EPS, beat on revenue. Diagnostics is growing. Life science is stabilized. Margins are healthy. If you're an algorithm, you're hitting the buy button.
And they did in the pre-market. That explains the pop.
But then the humans woke up, brewed their coffee, and looked at the 2026 outlook. So let's talk about the bear case. Why did everyone hate the guidance so much?
It all comes down to expectations versus reality. The narrative for 2026 was supposed to be the recovery year.
Right, a V-shaped bounce.
Exactly. Investors were positioned for that. a return to high growth as biotech funding unlocks.
And Revvity basically said, not so fast.
Precisely. Management set the revenue guide for 2026, but the number that really spooked the market was the organic growth forecast. They pegged it at only 2 to 3%.
2 to 3%. That's barely keeping up with inflation. If we're in a recovery, that sounds like a company that's stalling out.
And that's exactly what the bulls did not want to hear. And this raises the multi-billion-dollar question, are they just being super conservative? You know, sandbagging?
Setting the bar on the floor so they can easily step over it.
Right. Or do they lack confidence in the market recovery?
Well, what did they say? Did they give a reason for being so pessimistic?
They were very explicit. They stated they are not modeling a recovery in preclinical spending or academic and government funding.
Wait, really? Because every other headline I see is about green shoots in biotech. Funding is coming back. IPOs are opening up.
No, and that's the thing. They see it too. Prahlad Singh, the CEO, actually spent a lot of time talking about those green shoots.
So they see them, but they won't put them in the math.
Exactly. They said, we see the green shoots, but until those shoots turn into signed purchase orders, we aren't putting them in the guidance. They're being hyper cautious.
I can see why traders hated that. But there was something else, right? The first quarter guidance honestly, it looks scary.
The Q1 pothole. This was probably the trigger for the algorithmic selling. Management guided Q1 margins down to approximately 23%.
Whoa, hold on. They just posted nearly 30% in Q4. And Q1 drops to 23. That's a cliff. What happens in Q1?
No, it's not lost business. It's a perfect storm of temporary headwinds. First, there was an extra operating week in the fiscal calendar.
An extra week, doesn't that usually mean more revenue?
It does, but it also means an extra week of labor costs. And if that extra week doesn't come with a linear bump in high margin revenue, your margins get crushed.
So your costs go up, but your mix gets worse.
Exactly. Then you have tariffs. And they have these cost efficiency programs that cost money now, but won't show benefits until Q2.
The dreaded second half story.
Investors hate second half stories. It requires you to trust that everything will go right in 6 months. Traders want performance now.
And what about China? Still a drag.
Always. The perennial headache. Diagnostics in China are still down double digits. They're dealing with what's called DRG volume pressures.
DRG. Break that down for us.
Diagnosis-related groups. It's basically payment reform. The Chinese government is changing how they reimburse hospitals.
So hospitals are incentivized to run fewer tests.
Precisely. And management expects that headwind to last until mid-2026. So you combine a China drag, a margin cliff in Q1, and a conservative full-year guide.
And you get a 5.5% sell-off.
Yeah.
Okay. It makes sense mathematically. It's a show me story.
Exactly.
But let's pivot, because the qualitative commentary, the vibe, was totally different from the quantitative guidance. Let's talk about those green shoots.
This is where the nuance is. If you ignore the spreadsheet and just listen to the CEO, the tone was optimistic. He pointed to an uptick in M&A activity.
And M&A usually leads to spending, right?
Correct. And crucially, he mentioned clarity on NIH funding. When the National Institutes of Health budget gets settled, academic labs start spending again. The money is flowing, even if the purchase orders aren't signed yet.
And we saw this in the product lines, right? You mentioned reagents and instruments.
Reagents were flat, which was better than they expected. But the big signal for me was instruments. Instrument sales were flat.
Again, flat sounds boring. Why are you excited about that?
Because instruments are the canary in the coal mine. They're big capital expenditures. A lab cuts that first when they're worried. Instrument sales have been declining for 3 years. Seeing them stabilize means labs are ready to buy again. The bleeding has stopped.
The patient is stable, but management isn't ready to forecast the marathon just yet.
Exactly.
Which brings us to the part of the story I think is the most misunderstood. The bull case that got buried under all the panic. They're trying to pivot into tech.
The innovation narrative. This is what the long-term holders are betting on.
Signal Synthetica. It sounds like a villain in a Marvel movie.
It does sound futuristic, and it's their AI models as a service launch. It's part of their Signals One platform.
Okay, so what does this actually mean for a scientist day to day?
Think about the traditional workflow. You go into the wet lab, pipettes, beakers. You mix chemicals, you wait, you get a result. It's slow and disjointed.
And very expensive.
Extremely. Signals Synthetica integrates AI directly into that workflow. They call it lab in the loop.
Lab in the loop. I like that.
It means you move from the wet lab to in silico computer modeling and back again. You use AI to predict what will happen before you mix the chemicals.
Which speeds up drug discovery massively. And they have that big collaboration with Eli Lilly.
This is the validation stamp. It's huge. Eli Lilly is partnering with them on something called TuneLab.
What's TuneLab?
Lilly is basically taking their proprietary data and models and providing them to smaller biotechs through Revvity's platform.
So if I'm a small biotech, I can get access to Eli Lilly's secret sauce by subscribing to Revvity's software.
That's the value proposition. It positions Revvity as the operating system for the industry.
And are the numbers backing this up? Or is it just a press release?
The numbers are very real. Their software annual recurring revenue, ARR, is growing at nearly 40%.
40% growth. That's not industrial toolmaker growth. That's Silicon Valley SaaS growth.
It is. And that's the part the market is completely missing. Inside this Trojan horse of a value company, there is a software business scaling at 40%.
It's a tech company wearing a lab coat.
Right now, yes. But that hypergrowth engine is being dragged down by the flat instrument sales.
Let's talk about what they're doing with their cash, because they clearly think their stock is cheap.
They are buying it hand over fist. In 2025 alone, they repurchased $800 million worth of stock.
$800 million. And since mid-2023.
It's $1.5 billion. That is 12% of their total shares outstanding. Gone.
Wow. That's aggressive. You don't do that if you think you're overvalued.
Not at all. It's disciplined capital allocation. They also closed the ACD Labs acquisition in mid-January, which fits right into that software strategy.
Right, another bolt-on deal.
Exactly. But there is one financial headwind we have to mention. The tax man cometh.
Ah, yes.
Their tax rate is climbing. In 2025, it was a very favorable 14.5%. For 2026, they are guiding to about 18%.
That's a big jump.
It is, and it eats into EPS growth. It's just math, but it matters.
So, putting this all together, what is the read across for the whole sector?
I think Revvity's caution suggests that the life sciences recovery is real, but it is slow. It is not a V-shaped bounce, it's a U-shaped stabilization.
And for the stock itself, the drop tells us that meeting expectations isn't enough in this market. You have to raise the bar.
And Revvity refused to raise the bar. They kept it low.
Which brings us to my favorite part of the show.
Oh boy, here we go.
It is time for our This Is Not Financial Advice segment.
Disclaimer time. We are just two voices on a deep dive. Please do not trade based on this. We are not your financial advisors.
Exactly. But if I were a hedge fund analyst pitching to an investment committee right now, here is the trade I would be slamming on the table. I call it the hidden AI spin-out arbitrage.
Okay, I'm listening. What's the angle?
The logic is simple. Revvity is trading like a boring, slow-growth diagnostic company. That's why it's sold off on a 2% growth guide.
Fair. The market sees instrument maker.
But Bird Inside is that signal's business growing ARR at 40%. The market is assigning zero value to the AI platform.
So you just buy the stock?
No, that's too simple. You go long Revvity, RVTY. But to hedge the macro risk, you short a basket of traditional CROs.
Contract research organizations, the companies that do all the manual lab testing.
Exactly. You're betting on the tech and betting against the manual labor.
Interesting. So if the sector recovers, Revvity goes up. If AI takes over, Revvity goes up and the CROs go down.
Precisely. And here is the catalyst. You hold RVTY aggressively, betting that within 18 months, an activist investor forces them to spin off the software and AI division.
A standalone AI drug discovery SaaS company in this market. That would trade at what? At 10 times revenue multiple?
Easily.
Maybe more.
You unlock that value, you get the AI pop for free, while the legacy business uses its cash flow to buy back the rest of the stock. Meanwhile, your short on the CROs pays off.
It is wild. It is speculative. But I have to admit, that valuation gap on the software business is compelling. It's currently trapped inside of value stock.
Exactly, free the software.
Just remember, folks, that is definitely not financial advice.
So to wrap this up, Revvity beat Q4 significantly. They got punished for a prudent 2026 outlook and a scary Q1 margin forecast.
But the underlying engine, especially in software, is running hotter than the guidance suggests. And management is buying back stock like they know something we don't.
So I want to leave you with one final thought. Is Revvity's management being smart by setting a low bar they can easily crush? Or do they know something about the fragility of this biotech recovery that the rest of the market is ignoring?
That is the question. If they are right to be cautious, the rest of the sector has a lot further to fall. If they're wrong, and the recovery is real, this stock is on a massive sale.
Something to chew on. Thanks for listening to this deep dive on Revvity. This has been Talk Tickers. We'll catch you on the next print.